Hello, Super Saver. I hope you're healthy and well. So, things have happened so fast, I retaped the beginning of this video 3 times in the past 20 hours. As of shortly before noon today, Friday, March 10th, one-time tech darling Silicon Valley Bank is officially the first bank failure since October 2020. Keep in mind, I don't have a crystal ball, but what better time than now to wrap up our FDIC series about how to keep your money safe in times of market turbulence with today's video. And specifically, the 3 questions I'll be answering are: 1. Does the FDIC have enough money to cover a total banking collapse? Bankageddon. 2. How a possible U.S. default might impact FDIC coverage. And 3. What we're doing with our money right now, including which T-bill I'm mostly invested in and why. Now, let me mention that at this point in time, I don't believe there is an impending Bankageddon, nor is it my expectation that the U.S. will default. So with that in mind, let's dive in, Super Saver. As many of you already know, FDIC insurance covers depositors' accounts at each insured bank, dollar for dollar, including principal and any accrued interest through the date of the insured bank's closing, up to the insurance limit. And the standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. For more details on how FDIC coverage works and some ways to increase this coverage, check out our FDIC 101 video here that I've linked below. That video also explains the FDIC's primary responsibilities when one bank actually defaults. One bank default. Sounds like it should be manageable for the FDIC. But what happens when 2, 10, or 100 banks default at roughly the same time? Does the FDIC's Deposit Insurance Fund, also known as DIF, have enough money to cover that scenario? Or worse, does the FDIC's Deposit Insurance Fund have enough money to cover the scenario where every bank in the country defaults? Well, here's what the numbers from the latest FDIC quarterly banking profile as of September 2022 show. The FDIC's Deposit Insurance Fund insures about $9.9 trillion of our banking deposits. The Deposit Insurance Fund, however, only has a balance of $125.5 billion. This means that the FDIC's Deposit Insurance Fund can only cover about 1.3% of FDIC insured banking deposits. So no, if every single bank collapsed at the same time, if this Bankageddon happened, the FDIC would not be able to cover all our deposits. But that's simply not how insurance works. It does not cover and is not designed to cover Armageddon nor Bankageddon scenarios. Your life insurance company does not have enough money in its coffer to cover total loss of life, to cover the scenario where every single customer who buys a life insurance policy dies at roughly the same time. Your car insurance company also doesn't have enough money in its coffer to cover the scenario where every single insured car crashes at roughly the same time. And similarly, the FDIC does not have enough money in its coffer to cover the scenario where every single FDIC insured bank collapses at roughly the same time. Of course, there is a greater correlation, a greater likelihood between random banks collapsing at roughly the same time, for example, during the Great Recession of 2008, or during bad economic times in general, than there is between random people dying or random cars crashing at roughly the same time. Having said that, the scenario of every single bank in the United States of America collapsing at roughly the same time, Bankageddon, is in my mind a highly unlikely fear-mongering scenario at this point. Because as we can see from the FDIC's bank failures in brief for 2001 through 2022, during normal times like here and here, the number of bank failures per year is typically in the single digits. And yes, I will talk about how the FDIC handled the Great Recession of 2008 here. Before I do, though, it's important to understand what I said earlier, that the FDIC's Deposit Insurance Fund covers about 1.3% of FDIC-insured banking deposits. This 1.3% FDIC insurance coverage ratio is generally known in the industry as the FDIC's reserve ratio. And at 1.3%, it's fairly close to the minimum reserve ratio requirement of 1.35% that was written into law by the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 in the aftermath of the Great Recession of 2008. And actually, as you can see here, the FDIC's reserve ratio had been steadily increasing towards this 1.35% minimum reserve ratio requirement since the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was passed. It even went above the minimum requirement of 1.35% for a few quarters, as you can see here. The reserve ratio fell below 1.35% again only when the pandemic hit. And this drop, from what I can see, was due not to a fall in the reserve fund, but caused by the higher level of insured deposits in the overall banking system because so many of us were at home and not spending very much money, saving basically, and driving up insured deposits. At the end of March 2020 and June 2020, the average quarterly increase in insured deposits was about 6.5%, compared to an average quarterly increase of 1.5% between June 2005 and September 2022. You should know that if the reserve ratio falls below 1.35% or is expected to within 6 months, the FDIC generally must adopt a restoration plan to restore the DIF reserve ratio to at least 1.35% within 8 years. Going back to this chart though, this here, where the FDIC reserve ratio dipped and then went negative, that's what happened during and in the aftermath of the Great Recession of 2008. What you need to understand is that the reserve ratio's dip here into negative territory has more to do with accounting methodology and how reserves for potential defaults are being built up on the FDIC's balance sheet, rather than how much cash and liquid assets the FDIC actually had at its disposal. Because the FDIC, it didn't actually run out of cash and liquid assets here. And from the horse's mouth, during this period, the Deposit Insurance Fund's negative balance itself did not mean that the fund lacked the liquid assets necessary to quickly resolve failing banks and pay insured depositors. This black line shows, in a nutshell, the amount of cash and liquid assets the FDIC actually had on hand to sort out possible default situations, even when the Deposit Insurance Fund balance showed a loss due to accounting methodology, as marked by the light blue bars here. These light blue bars showing the Deposit Insurance Fund in minus territory are analogous to this dip here in the FDIC's reserve ratio that I showed you in this earlier chart. And from what I understand, some of the super savers in our community who had deposits at banks that failed during the Great Recession of 2008 can also attest to the FDIC's liquidity at that time. Because based on the comments and stories you've shared with us, and which we've shown in an earlier FDIC video, it appears that your money was returned to you quickly and without major fuss. Now, for those of you who are interested in diving into the details on the FDIC's accounting methodology for contingent loan loss reserves in its Deposit Insurance Fund, and why it showed an accounting loss versus its actual liquidity position during that period, as customary, I've included this crisis and response report from the FDIC that I just referenced, as well as the other sources used in this video in the description below. Right, so what have we learned so far? 1. The FDIC does not have enough money in its coffer to cover a Bankageddon scenario. So, if every single bank in this country collapsed at roughly the same time, the FDIC's Deposit Insurance Fund would not be able to cover all our insured deposits. As I mentioned earlier though, regardless of whether it's life insurance, car insurance, iPhone insurance, or FDIC insurance, insurance usually does not cover and is not designed to cover Armageddon-like scenarios. And more importantly, 2, Bankageddon has not happened up to this point. And the last time we came close to this in recent history, during the Great Recession of 2008, the FDIC had enough cash and liquid assets to resolve failing banks and return insured funds to depositors quickly. Sounds good so far, at least to me. Now, let's talk about how a possible US default might change all of this. I'm going to preface this by saying that we're hypothesizing about a situation that has never happened before. So it's not really possible to say what would happen exactly to FDIC coverage if the US were to default. But it is possible to show you how much and how big a role our government played in the last big financial crisis, the Great Recession of 2008. And for us to imagine what might happen if our government could no longer play this role in the next financial crisis, if it were to actively allow a default to happen. Because remember, this potential default that some are proselytizing about, as much as it may be about finances, at its core, it's driven by politics from both sides. Anyway, back to how much and how big a role our government played in the last big financial crisis and what it did to stabilize the banking system. Let's start with the Troubled Assets Relief Program, TARP. TARP was the government's response to combat the Great Recession of 2008, what they deemed as the worst financial crisis since the Great Depression. Under TARP, $466 billion of government funding was allocated to these 5 key areas. $245 billion to stabilize banking institutions, $80 billion to stabilize the auto industry, $68 billion to stabilize insurance giant AIG, American International Group, $46 billion to help struggling families avoid foreclosure, and $27 billion to restart credit markets. Plus, the Federal Reserve committed an additional $112 billion to rescue AIG, bringing the total government support in this instance to about $578 billion. So, what we can learn from this is that while the FDIC was able to take care of its failed banks and return protected funds to depositors, ultimately, it was the U.S. government that stepped in with its deep pockets to maintain the overall stability, integrity, and faith in our banking system. Had the government not stepped in with its deep pockets to maintain the overall stability, integrity, and faith in our banking system, it's completely unclear how many more banks would have failed, how long the FDIC's Deposit Insurance Fund would have been able to cover these bank failures, how many super savers would have lost their hard-earned savings, how much they would have lost, and how many companies who relied on bank financing would also have gone bankrupt. And yes, what I am hypothesizing about is that if the US were to default, it would be tough for the FDIC to carry on as it did during and after the Great Recession of 2008. Basically, the US government saved us that time by using its full faith and credit. But what about a hypothetical US government in default? That US government probably wouldn't be able to stabilize our financial system and save us. And that's what I mean when I say if the US were to ever default, we'd all have much bigger problems. But that's also why I don't think a US default will happen. Not at this point in time, because the stakes are simply too high. What's at stake isn't just about US Treasury bills, notes, and bonds. It's not just about the FDIC. It's about the overall stability, integrity, and faith in our banking system. And as much as some don't like to think or believe it, it's also about the integral role that this stability, integrity, and faith in our banking system plays in financial markets worldwide. Because make no mistake, if the US defaults, there will be a domino effect on other major world economies, which is a great segue into what we're doing with our money right now, including which T-bill I'm mostly invested in and why. As we always say in the industry, past performance is not indicative of future results or returns. But for me, it's the best I have right now. That, coupled with the prospect of a global economic meltdown if the US were to default, for us, for now, we're still sleeping well at night, not expecting a US default, nor Bankageddon, nor an FDIC collapse, for all the reasons I've talked about already in this video and generally on this channel. We still have our savings and checking accounts with the same FDIC-insured banks that we've been with the past few years, making sure that our deposits are below the FDIC's standard insurance limits. We're still staying put with last year's I-bonds, waiting until mid-April to decide whether we'll purchase more. And we're still laddering into short-term treasuries in both our retirement and non-retirement accounts as the Fed continues to raise interest rates. For the most part, we decided to move back to laddering the 13-week T-bill after a brief stint with the 17-week T-bill, because even though the rate on the 13-week is a bit lower than the 17-week, the 13-week has auto roll and the 17-week doesn't, at least not with my broker. And I'm a girl that needs auto roll in my life. That's what I've learned. And by the way, US Treasuries, that's what folks usually flock to during times of uncertainty like these, even when the debt ceiling has been reached. Check out this video here if you haven't seen it already on how to invest during a debt ceiling crisis. As our trademark saying goes though, everyone's financial journey is different and you need to do what's best for you. So tell me and the other super savers, what are you doing with your money right now? Drop a comment below. All right, my financial friend, as always, I hope you enjoyed this video and learned something new. And if you did, don't forget to share with those you care about and of course hit that thumbs up and see you again very soon with another brand new wealth building video.